Michael Purves is joining me this morning. A pleasure to have him, and I'm happy to say, ahead of the holiday, CEO of Tallback and Capital Advisors. Mike, thanks for being here today. Appreciate you.
Great to be on, Oliver.
That was a pretty bad number, wasn't it? Because the other lowest was 49 outside of COVID. That was the worst one since COVID.
It certainly was, and new orders was pretty ugly as well. You know, when you look at some of the subcomponents there. But look, at the end of the day, this is one print out of several. We're dealing with an economic cycle that has a lot of noise on a lot of individual prints. You really can't draw too many clear conclusions here. And, you know, just the other day, we had some JOLTS numbers that surprised to the upside here. I think the most important thing to look at is just, you know, economic data, the employment data, rather, that is, if the employment data really weakens here, then we have a problem here. But if an ISM survey is gets prints below 50 and it's the worst print in a while, I don't know if that's really an indication that things are broken in the economy. So I'm going to say, look, you got to kind of withhold judgment right now in terms of predicting where the economy's going.
I mean, it's been trending lower.
The economy's still pretty strong.
It's definitely been trending lower. ISM's definitely been trending lower, right? Just this is kind of a crack. I mean, we were hitting obviously like 60s, a couple of years ago. But to your point, in the ranking of weighting, right, survey data generally not the top ranking. But to me, it really embodies kind of the pickle we're in, because the prices paid don't seem to want to come down, whereas the activity really has. And that's kind of like even if it's just survey data, if that starts happening in hard data, right, that's kind of the worst case scenario.
That was the most disturbing part of this morning's print was exactly what you just said, is that it looks like some sort of industrial stagflation, if you will, which ultimately will bleed into the consumer if in fact that is a real trend and not just 1 month of an ugly print here. So you're absolutely right. That's the thing to be focused on there. But again, these surveys are volatile. They move up and down, and and they're surveys. They're not hard data. So let's withhold judgment, but let's be aware of what the issues are. The real issues is there sort of industrial stagflation.
Okay. Mike, when I'm looking at your recent market analysis, it seems mostly about intra-market correlations, the concentration skew, what that means for breadth. So it seems like that's where you think our focus generally should be, though, still at the moment, rather than the kind of macroeconomic stuff?
Yeah, well, look, I think you always focus on the macro there. I think the macro conditions broadly in pretty good shape here. There, I think there's a discussion about term premium in the yield curve that that.
Think that spike was Trump? Where do you stand on that, Mike?
Well, yeah, I mean, look, if you look at the yield curve since the debate last Thursday, it's steepened about 20 basis points. It's all on the back end, right? It's not the short end getting bid. Correct. The back end selling off. If you look at when Trump won in 2016, the yield curve steepened by 20 basis points in 2 or 3 days there, and coasted up a little bit after that, and then went steadily down after that, right? I think that's the question, though, is that whether if we do get a Trump victory here, and obviously that comes with a lot of footnotes, what happens in the House and the Senate and so forth, but I think there's a real legitimate question about whether there's sort of a Trump turn premium that will stay embedded there, because looks like he's prone to having a loose fiscal, loose monetary condition, unlike today where we have a loose fiscal, relatively tight monetary condition.
Right. So, but no shortage of pressure from our existing president, who said multiple times he thinks the Fed's going to cut. Mike, the steepening, though, it really happened. If you go to the intraday chart, it was on the PCE print, because bonds actually were firm after the debate. They were firm in the response to PCE, and then they reversed. And then it was like from Friday to Tuesday, basically. So, it feels to me, part of me thinks maybe the market was like still holding hope out for a July cut or something, maybe.
Yeah, I think there was always some hopium about a July cut there. But look, Oliver, I think what's important is to zoom out on, okay, let's say we get a cut in September or we don't get a cut in September. I think you have to step back and, think about two questions here. One, is it really going? Is 25 or 50 bips this year going to really have a material impact on improving the economy here? Because the economy has roared forwards without, despite the interest rate hikes, despite one of the most aggressive hiking cycles ever. So it's not clear to me how much that really impacts. Cut will help. It might help boost markets.
No, great point.
There, but I'm not
real
sure
economy.
It's really. Yeah, I'm not sure it's really going to flow through that much, and particularly if a term premium is sticky. Things like mortgage rates are not going to be coming down then, right? Or maybe not coming down in a material way if the term premium is higher there. And if the inflation data continues to be saying that we're not getting a clear path to 2%, which I think it's certainly my base case, I actually think that Powell's going to really, I'm increasingly inclined to think that Powell won't cut at all this year, if anything, because if Trump does win, he's going to want to put as much dry powder in the tank as he possibly can.
I guess, yeah.
Right? There, because if I'm right that Trump win means a loose monetary condition, down the road, then he's going to want to keep rates as high as possible, unless the data really falls apart on us.
Well, I think it also, not to game too much into the political theory, but I don't think he's going to be around for very long if Trump does win.
Well, they're not exactly best friends, are they? And his term's only a year and a half away.
So I feel like he might want to do one for his own record before he gets out. Mike, okay, but back to the point of correlations in markets, because really the most important thing at the end of the day for most people is, do I try and pick stocks or do I just park it in the index? And this has been like the biggest victory for index funds since their invention, the super highly concentrated market. It's like the number of stocks beating the S&P is at a record low, according to Ed Clissold's analysis. So it's like, why even bother? Buy the index.
Well, it's a great advertisement for passive, or it's a great advertisement for really good stock pickers, right? And look, the breadth in the market we all know is horrible. I think just 25 names of the S&P 500 are actually beating the S&P 500, which is kind of remarkable there. But look, at the end of the day, correlations across stocks and across sectors are at the lowest levels they've ever been since really the late 1990s. And what's really interesting, Oliver, is that ultimately weighs on the VIX, and your earlier guest was talking about options and all that. But there's a real case here where correlations across stocks is going to keep finding new lows, partly because of this tech outperformance from Mag 6 or whatever you want to call it. Is so they're such big market weights, and they're so decoupled. And that's going to drive down things like implied correlations and realized correlations, which is also reflective of basically a pretty healthy risk-on condition there. Now, you don't want to have, you'd love to see a better breadth condition there, but that doesn't mean that the S&P 500 as an index equity rally is really in jeopardy. It just means that, look, at the end of the day, Oliver, earnings growth is driving the outperformance there. Mag 6 earnings growth is far superior to the SPX equal weight earnings growth. SPX equal weight is up 4% or so this year to date, and the earnings are up 4% year to date, right? It's really as simple as that. Mag 6 earnings are up 25% year to date.
Sounds like we go with it. We embrace it. That this is just how disruption works. The productivity and the earnings flow upward.
Yeah, and look, at the end of the day, from an equity rally point of view, you want an earnings-driven rally, not a PE expansion-driven rally, and that's what you're seeing here, which is actually quite healthy. So it's
last couple of weeks though, that got a little frothier though. Basically, since Apple, I mean, Apple was pure valuation move though. I mean, last couple of weeks,
that's true.
Juicy?
That's true. Yeah. The overall index though is really. If you look at Mag 6, for example, you've actually had PE contractions since the end of last year,
That's
right?
amazing.
Because the earnings have grown faster than the price level there. If you look at the Mag 6 market cap weighted index.
Wow.
So that's healthy about this rally. What's not as good is that you'd love to see, bank stocks and retailers and the rest, really start, surging there, but their earnings growth is just simply not only superior from a quantitative point of view in these big tech names, it's a lot more, sort of predictable. there. They're like super high growth utilities, with the ability to do buybacks, which only reinforces earnings growth, resiliency and reliability there. So it's sort of quality and quantity of earnings growth in these big tech names is really, really compelling there. Yeah. And there's less ordinary economic risk in some of the others.
Better to keep.
Obviously, NVIDIA begs a lot of footnotes on that point, but
sure.
There because it is a chip stock ultimately.
Better to keep with the index and the trade then than try and get fancy with rotation. It seems like, Mike, you're pretty kind of content with the.
Like I'm not a big. I'm not. Look, I think I put out a cautionary note because big tech got super overextended early last week. And that NVIDIA surge there, but that was technical overstretching.
Right.
Like it was just ridiculously overbought there from here through the next several months, certainly through the rest of the summer. I'm gonna stay with what's been working. I think these tech monsters are earnings monsters, and I'm gonna keep I'm keeping it simple and just working with that. I think that's if you put a gun to my head and said I had to pair trade into the end of the year, I'd be long Mag 6 and short the SPX equal weight.
All right, love it. Ride the momentum wave. Hey, July 4th trade, baby. What's not to love? America first, building the bots, all the capital's flowing our way, same as it ever has.
Yeah. Strong dollar.
Let that bird fly, baby. All right, Mike Purves, appreciate your time, sir.